Good morning. My name is Karen Matheson. I'm a project director here at the Center for Global Development, and welcome. I see a couple familiar faces, including someone from the Treasury Department. Hi, Anthony. I really appreciate everybody coming out. I hope there are lots of people online. I am super psyched for this event. The timing, is a little bit tricky. It's cold, and we're getting close to the holidays, but this issue of stablecoins is so dynamic. It's changing so fast that I felt like everything that we prepared to talk about would be overtaken by events if we waited even another month or so. It's just that kind of a world, which for somebody in development finance is very exciting, because development finance world tends to be associated with a lot more churn. So this is our very first event on stablecoins. I'm sure it's not going to be our last. As you'll hear today, stablecoins represent a new global phenomenon, and they have the potential to transform the global financial system. People have a lot of views on that, whether it's good or it's bad, but the fact of the matter is it is. So we're going to focus a bit today on how stablecoins can be used as a form of development finance. And right now, the Venn diagram between crypto and development is small, but I think it's going to overlap more and more and more. And we have some great speakers who are going to be able to share some really interesting case studies with you. And again, I suspect very, very few of you will have been aware of the kind of thinking that's going on out in the field. So I'm going to just show you a couple of slides for the stablecoin curious, but for whom this is kind of a new issue. And then we will get right to our panelists. So, okay, so very, very quickly, stablecoins, they're digital currency, pegged one-to-one to another asset. It's usually a fiat currency, dollar or gold, not always. Under the US Genius Act, they have to be backed 100% by safe liquid assets. Talk a little bit about that later. Right now, they have a market cap of more than 300 billion. They're growing really fast, as you'll see in the next slide. Federal Reserve estimates that could rise to 3 trillion. Citi is a little more bullish, maybe 4. So we are going to be, stablecoins are going to become systemic, no question about it. 95% of them are pegged to the US dollar. But over 80% of the transactions are outside of the US. And I think, again, as we talk more this morning, you'll understand why that is. That the use case for us in the United States, where we have easy access to a stable currency, is not as clear as it is outside of the United States. Transactions surpassed 26 trillion in 2024. Most of that was related to the buying and selling of other crypto, but that is also starting to change. And then finally, they have lower barriers to entry than fiat money. You don't have to be a bank to issue a stablecoin. So here's just a quick graph. And so you can see how they went from basically nothing, right, when they were actually launched in 2014 to now. It's kind of interesting. You'll see that big jump in October, and then there was a bit of a fall, which represents that kind of withdrawal from crypto. But I suspect, again, that's going to jump right back up. So let's just do a quick slide on, okay, why do they appeal? If it's not obvious to us, what's the big deal? So the big deal is that they are very, very cheap to send back and forth. They're instantaneous. I mean, if I had a stablecoin wallet, which I don't, I could send you a stablecoin, in a minute or less. And so this is really a big deal for international transactions. Any of you who have dealt with SWIFT or anything like that will know it takes, 1 to 3 days. It's really onerous, and that means that makes the use case very, very high for kind of any international transaction. They're less risky than other forms of cryptocurrency, but they're not risk-free. We will talk about that. And then really importantly, they offer a reliable store of value. They can mitigate local currency and inflation risks, particularly, and this is particularly valuable in really volatile markets. So you'll see very rapid stablecoin adoption in places like Nigeria, Argentina, Venezuela, where you might expect. Moving right along. Okay, so what I wanted everyone to focus on, just for a hot minute, is that there are only two stablecoins that dominate the entire market. We actually have a little category for other up there, but it's really hard to see because it's so tiny. There's some debate about the size. We have a few different sources, and maybe our stablecoin experts will be able to give us a sense later. But we're looking at 95% plus being dominated by two currencies: Tether, based in El Salvador, and USDC, which is based here. There are issuances being announced all the time. Every single day, I actually check for a stablecoin issuance. Today, a member of the Malaysian royal family announced he would be issuing a stablecoin backed by Malaysian currency. So I was like, yeah, here we go. So it is that kind of world. Super quickly, not all stablecoins are stable and not all stablecoins are equal. This is something that Heath Tarbert said on a podcast recently. Heath Tarbert is he's the head of Circle, formerly at the U.S. Treasury Department. And their reliability depends principally on these four things. So the nature of the peg, I mentioned before, mostly US dollar, some gold, but it can be other currencies, and it can be even something called algorithms, which I'm so not going to go into because I'm going to lose my entire audience, but basically it's much riskier. The regulatory environment, okay, all over the place. There's absolutely no uniformity of regulatory environment. Some places don't even have regulations that are clear on stablecoins. That's why the U.S. Genius Act was such a big deal. The quality of the assets backing the peg. Now, this is really important. Again, are they really backed by liquid assets that are easily accessible? And the answer is maybe. And I'm going to give you a super quick example of this. So Standard & Poor's rates stablecoins 1 to 5. And it's based on one simple question: how likely are they to hold their peg? All right. Well, they think that Circle is likely to hold its peg. They're rated number 2. That's strong. They just downgraded Tether to a 5. Okay, that is weak. That is the worst rating. So now you have one of the biggest stablecoins in the world where at least one rating agency is pretty skeptical. I think there's a lot of people in the industry will dispute whether that's fair, but it is there. And the reason for that is because they're worried about the quality of assets backing the peg. There's crypto in there, other currencies, there's corporate bonds, blah, 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 blah. So that's the worry. Then the other thing is the quality, the stability of the asset custodian. Well, what do I mean by that? Well, it means who is holding who's holding those reserves for you? And because it's not going to be the Fed. And so a few years ago, Circle actually broke its peg for a minute because a Silicon Bank had over $3 billion of their assets. And when it was clear Silicon Bank was in a lot of trouble, there was worry that Circle would not be able to access those assets, okay? And so that led to this rapid redemption. All right, last slide. So I mention this because look at the size of the Treasury bill holdings right now. We were talking with the two of them, Tether and USDC. I mean, they've got more than South Korea and Saudi Arabia, and that's only going to go up. And so that then does create some potential concern about redemption risk. Okay, so that I'm going to pretty much stop there. And I just wanted to give you a couple of perspectives. Stablecoins provoke very strong reactions. It's been my experience. So there are a lot of people in banking finance who think, look, this is happening. They're going to be, they're a bridge. It's going to be like snail mail to email. This is going to be really something that will transform the financial ecosystem in a good way. And then you have people who disagree, including this Nobel laureate, who says they may dazzle, but they risk destabilizing finance while enriching a few, which is an interesting claim, since the whole point of this is to sort of decentralize and democratize finance. And then finally, the IMF released its first big paper last week, noting that they have far-reaching implications for the international monetary system, both as a novel payment medium and a potential disruptor. So that's what we're going to get into now. Thank you very much. And I'm going to invite my speakers up and do a quick intro for them, and then we'll get into it. All right, come on up, guys. I'm going to start with Brian Whippo here. So Brian works for this organization called the Algorand Foundation, and these guys will explain in a minute a little bit more about where they work. But I wanted to read something funny from your LinkedIn profile. It says, he leads a team of developer advocates who enable Algorand's community of software developers to fall into the pit of success when building applications on the Algorand blockchain network. I'm not exactly sure what that means, so you can help us with that. And previously, you were with Morgan Stanley for about 15 years, right?
Yeah.
And then we have Paul Wong, who's a director at the Stellar Foundation, the Stellar Development Foundation, which aims to create equitable access to the global financial system using blockchain technology. Works with partners on tokenizing real-world assets. You guys all have glossaries, so I have these words in there for you if you're struggling a bit, because it takes a little while to get used to all the lingo. But there are a couple of things that Paul's done that are amazingly cool, including working on Global Cash Assistance Program for UNHCR and with a consortium of Ukrainian banks. And he'll tell us a bit about that. And before that, Paul, you were at the Federal Reserve Bank Board and the Bank for International Settlements. You're very interesting because you've been on the regulatory side and now you're on the stablecoin side. So I think that's very interesting. And then Mary Svenstrup is a non-resident fellow here at CGD. She was a special assistant to President Biden, a senior director for international economics, working for both the NSC and the NEC, and before that, a civil servant at the Treasury Department, which is where we met. And she was a real rock star. So welcome. Okay, so let's get into it. Starting with Brian, maybe you could help explain to the audience, which I think is kind of crypto naive, a little bit about what is the Algorand Foundation trying to accomplish, and maybe could you share a couple of initiatives that involve the use of stablecoins to support humanitarian or development objectives, and then why not just use regular cash or Venmo or something associated with the bank? Why? What's the appeal of the stablecoins particularly?
Sure. So thank you for having us up here and having me. The Algorand Foundation looks after the Algorand blockchain, so we're a layer 1 blockchain. And
I'll stop you right there. Yeah. What is layer 1?
It means that we're just a standalone blockchain. We're not built on top of another blockchain. That is a model that exists in the realm of blockchains, but we stand on our own.
Okay.
So that's more stable, you could say, because it's just a solid foundation.
All right. Thank you.
Yeah, the Algorand Foundation has a mission to power a world where information has integrity and innovative solutions can scale using the blockchain. And powering stablecoin transactions and the applications that can use stablecoins is pretty central to our mission. We get really excited about financial empowerment and creativity and inclusion and so forth. So I will touch on a project that's been built on the Algorand blockchain that I think is really at the heart of your question. So this company is called HisabPay. They operate in a number of places, but primarily in Afghanistan. And they've created a stablecoin there that's not on the graph. It's an Afghani stablecoin. And they are enabling people to do a few things: receive humanitarian aid payments on the blockchain through a digital wallet that people can have on their phone, and then they can buy stuff with this. And it could be food in a store from a merchant that has a point of sale terminal, or it could be paying their electric bill or buying phone airtime or things like this. And so you have this combination of leveraging blockchain technology to enable extremely low cost, fast, and frictionless payments, either incoming as an aid payment from a donor, or within the local economy for the everyday things that people buy and sell. And this is all powered by blockchain, and I think is an excellent example of where a stablecoin can operate in a context where there is no or very little existing financial infrastructure, which is very different than the world that we live in here in the United States, where we take a lot of things for granted. You mentioned Venmo, right?
Right.
No Venmo there,
Yeah.
right? There may not be a bank that people have access to, or women will not have access to financial services because of the rules of the land. So in these fragile economies, the problems to be solved through technology solutions, and stablecoins among them, are quite different than the problems that we might think about on a daily basis.
And I think it's important to mention that the Hisab Pay coin is linked to the Afghan currency.
Right.
So you wouldn't necessarily see that stablecoin use outside of the country.
No, this is sort of within the walled garden, if you will, of the country.
Yeah.
Yeah.
So Paul, can you explain how Stellar differs from Algorand in terms of its objectives and the way you operate? And then also, maybe tell us what you think the strongest use cases for stablecoins are in the development finance context, and why. And if you've learned any particular lessons so far that you can share from your experience.
Absolutely, and thank you again for having me. The Stellar Development Foundation is very similar to the Algorand Foundation. We are focused on expanding equitable access to the global financial markets. That means that we are focused on everyday financial services, everything from payments to investments to credit, and also we're moving into the insurance sector as we speak. The big use case that I see for this crowd, and I'm going to try something new, which I kind of told you backstage. The big use case, I think, for stablecoins and for tokenized investments is really about risk management. Something that I talk to firms around the world is, are you comfortable sending millions of dollars to an Afghani bank or to a Haitian bank? I think the answer is no, right? So as a donor, what you want to do is really manage your credit, liquidity, and operational risk, and you can do that much better with an institution like Circle, with an institution like PayPal, with commercial banks that are starting to also issue their own stablecoins on Stellar, Algorand, and other blockchains. The second aspect is really about managing reputational risk. So in many ways, the beauty of blockchain is that it provides transparent, traceable, and audible payments in real time. So by providing transparency, traceability, and auditability, what we're able to do is reduce fraud and malfeasance in the development space. I think over a decade ago, the UN General Secretary basically said something to the effect of 40% of development aid is lost to fraud, malfeasance, and other bad things. And that's a huge amount. And in today's funding crisis, transparency, traceability, and auditability are actually quite key, right? And we know this from the Trump administration, which has basically said, we want to use blockchain, and we're going to make the US the capital of digital assets. From a individual perspective, what we're able to also do from a risk management perspective is, if I send you funds, I send you funds. You are the true beneficiary. It's unlike a bank deposit where you talked about women, where the woman might share the account with the husband, and the husband might use those funds for different purposes. When we send funds to a woman in a developing country, the woman is the beneficiary and is, in most cases, the only one that can kind of cash out using those funds. So, what's interesting is I want this group to think about using stablecoins from a risk management perspective because that's what stablecoins provide. It's a different level of risk management. It's a different way of thinking about risk. You asked about lessons learned. I think for us—
In a case, can you give us an example?
Sure. An example is today we're able to send payments to Ukraine within a matter of minutes. So UNHCR is able to send actually anybody in the world a payment within a matter of minutes. It takes about 2 minutes to download the app, authenticate who you are, and the money magically appears in the digital wallet. So you don't need a digital wallet before you receive the money. It basically sends you a text or email. You download the app, you authenticate who you are, money magically appears. Once the money is in your account, you can off-ramp in a number of ways, whether it's through MoneyGram. So you can off-ramp in MoneyGram in over 180 countries. You can off-ramp to a debit card, Visa or MasterCard. Depending on which wallet, depending on where you are, you can off-ramp to mobile money. In the US, you can off-ramp, and also in most advanced economies, you can off-ramp to a bank account. So in Ukraine, for example, if the UN were to send you funds, you can off-ramp from your digital wallet to your bank account within a matter of 2 minutes. So the total time to send transactions anywhere around the world to Ukraine is 5 minutes. That is much shorter than
Crazy.
Traditional systems. We have a partner that is making payroll. Making payroll to healthcare workers in the Middle East. It takes about a month to make those payments because those payments have been made through the post. So it's basically a check system. And today, the GIZ is able to make payments within a matter of seconds, which used to take, months.
Lessons learned.
Lessons learned. This stuff is really hard.
Okay.
So it is not easy to implement a solution in Afghanistan. The off-ramping is really key to the success of the stablecoin. So it's all about usability, right? And it's about interoperability with traditional systems. Mm-hmm. Every country is completely different. Every wallet is completely different. So, MoneyGram is Stellar's global off-ramp partner. It's in over 180 countries. The strength of MoneyGram varies by country. Our ability to off-ramp to mobile money varies by country. Visa, MasterCard networks also vary by country. So it's like, yes, we can off-ramp to Haiti using a debit card, but who in Haiti, how many businesses in Haiti are accepting Visa and MasterCard? Mm-hmm. Not many.
Yeah. So upfront costs are significant. This brings me to Mary. So as I noted, stablecoins invoke very strong reactions, right? You have some who stress the potential to revolutionize, democratize finance, but others who think they're going to be really destabilizing. So I would just love your perspective on the evolution, what you consider the greatest risks, and maybe if you could comment on this idea of, increased transparency and accountability, because like the Times just had a story yesterday saying, oh no, there's another vehicle for illicit finance. So your thoughts on that would be great.
Happy to, and thanks for inviting me. It's really great to be here, particularly in the context of talking about some really interesting specific use cases that Brian and Paul mentioned. So I'll take more of the, the official sector view, and I found the 3 quotes that Karen put on the screen to be quite important, viewpoints that we see in the official sector. That, I think there is a growing recognition that, this technology, this innovation is here to stay, but still a lot of hand-wringing and concerns about it. And I think just to back up a little bit, we've seen a growing demand for faster, cheaper, more efficient payment systems, for as long as I've been working on this issue, for over a decade. And I think in part because the official sector, because governments were not as fast as they could have been in providing that solution, you've seen this incredible innovation pop up and help to fill that space. Just from the U.S. perspective, I think it's really striking, and we were talking about this backstage, thinking about a year ago in the Biden administration when, there really wasn't much support for thinking about, regulatory frameworks, to now there's bipartisan consensus supporting the Genius Act with some outliers. The shift is really notable. I think going forward, there are a couple different layers that I think are really important for us to think about closely to help enable some of the great work that Brian and Paul mentioned. I think one most closest to home is on the Genius Act implementation. People are watching really closely on two fronts. I think one on this market infrastructure bill that's going through Congress, what's going to be included there. And then two on Treasury's writing a lot of the rules that will underpin the Genius Act, and really thinking about how they're going to address some of the key risks. And the key risks, Karen mentioned some of these. One is on illicit finance, how they're going to fold this into, how the Treasury Department, does its illicit finance checks and enforcement on the traditional banking sector, how that applies, on the financial stability point, on the consumer protection. Another key issue is going to be on corruption and political corruption in this space. I'm not sure if that's going to be addressed anytime soon. Those are kind of the four buckets of risk. And I see those as really important. One, because I want to see a safe and sound U.S. financial system and global financial system. But I think also because the credibility of these tools would really be jeopardized if there was a financial stability issue or we see a major illicit finance issue come up. So I do hope that and I think that the experts that are working on this are thinking about these issues really closely, because it is important to get that right to underpin the system. And I think that the Genius Act is clearly going to be a key factor in the broader global landscape. You have some of the other advanced economy jurisdictions that are in different stages of setting their own regulation: Japan, Europe, Singapore. You have China and India's outliers where they're not using this. But seeing how the different large financial centers, advanced economies, big EMs, make their systems interoperable will be kind of the next big front. And I think the U.S. In their G20 year, this is going to be one of the issues that hopefully they'll take up. And will foster some real conversations. And I know they're already thinking about what types of reciprocal agreements they'll have. I think the last layer that's particularly relevant for this crowd and maybe some of the projects that you have is how the regulation actually unfolds in some of these markets and some of the developing countries. We've seen different types of uptake already. Karen mentioned Nigeria and Turkey. And those are really interesting cases because those governments, outright, Nigeria in particular, they outright banned crypto a few years ago. Despite that ban, they saw a huge uptick, a huge adoption of stablecoins. And that set off a whole issue where, they were downgraded by the FATF to the gray list. It created a lot of issues with their banking system. And then, more broadly, I think there's been a recognition now in Nigeria and some of these other countries that you can't just outright ban it and expect that it's not going to go anywhere, that you need to have a system where you're regulating this and bringing it into the light, in part for the illicit finance reasons, but also because of the monetary sovereignty, the risks that it poses to capital flows in these countries. And I think that there's a gap right now between the type of support that those countries need to get their regulatory frameworks right and the type of support that some of our international financial institutions can actually provide. I was really happy to see this report that the IMF put out last week that I thought was quite nuanced, got into some of the issues, but still at a pretty high level. And they have not yet, they talk about the technical assistance they're going to provide. They have some principles for what countries should be doing on their crypto regulations. But I think that that's the next phase of really getting the IMF, the World Bank, some of these other institutions more into the weeds with the countries to actually help them put in frameworks that make a lot of sense. And then the last point, I think that on the macro front, I think that there's a lot of opportunity. One example that I've been thinking through is we talk a lot at the Treasury Department and the IMF about social safety nets being linked to economic reforms and being able to go out and message country X is going to cut their energy subsidies and we're going to be able to show immediately to people. And you brought up the idea of mailing payments around. When we were doing this, thinking of post-Arab Spring, you have schools and post offices around Yemen trying to pass out checks. But if you could do something that was more instantaneous, that could be a whole new frontier in being able to communicate economic reform agendas and actually demonstrate the impact to people in a more tangible way to help build support. So anyway, that's just an area that I'm interested in thinking about more.
Thank you, Mary. So back to you, Brian. I was wondering if you could talk a little bit more about working in these fragile and conflict states. Like Afghanistan has to be one of the toughest environments. To what extent can you adapt what you've done there in other places? Have you already done that? How significant are the upfront costs when you try to start something similar in another place? And then do you routinely work with the authorities, central bank finance, or not? Because that's what's so interesting that Mary was sharing is that one of the challenges of stablecoins is they're sort of like the spotted lanternfly. Like you can want it or not, but it's coming. So
It's a very local reference.
it's a very local reference, yes. So over to you.
Yeah, so to answer your question, I think I want to separate a couple of layers of,
Okay.
this puff pastry, right? So the one layer at the bottom is the blockchain itself. So we'll use Algorand in this context. And it provides a number of capabilities to stablecoins and businesses that run on the blockchain. And then you have the businesses like Hisab Pay or others that are operating in these fragile economies. And I'm going to try to stitch these two layers together a little bit. So one of the big challenges in solving these economic problems and financial inclusion problems in somewhere like Afghanistan are the last mile problems. And as Paul mentioned, the ability to send money across the globe in a matter of seconds, the blockchain layer powers that, and it works extremely well. When you want to change a stablecoin balance into a physical fiat balance, you have to go to an agent on the ground and stand in line, and there's thick plexiglass and men with guns and things like this, right? And those sort of last mile challenges are where these businesses operate and make money and differentiate themselves and so forth. And those can vary significantly from country to country and economy to economy.
Yeah.
Sometimes there's cultural issues, sometimes there's internet connectivity issues. There can be a variety of challenges. And what we see essentially in our ecosystem is a diverse array of businesses that are familiar with the last mile problems on the ground, locally. They're spotted lanternfly, so to speak. And they know how to solve that and offer local users an experience that solves problems in their day-to-day life. And then, down one layer below, Algorand gives them the capabilities to make the digital stablecoin payments, or I'm going to add another element here, because Paul talked a bit about risk management.
Yeah.
The blockchain can enable risk management with tools such as the ability to claw back a payment or freeze a balance in someone's account. So on the ground, a company that is doing the user onboarding and on and off ramping, right? They're providing the KYC services, and then you get the blockchain can be used together with government entities or a stablecoin issuer to implement essentially enforcement actions, right? If you have a situation where something has been stolen or money ends up where it shouldn't be, or there's some kind of a court case that involves freezing someone's asset for whatever reason, those tools exist on the blockchain layer. And they're very composable, they're very flexible. So whatever the issue is on the ground, you can create technology solutions that help address those issues.
I see.
And one other thing I would mention around mitigating the malfeasance and fraud and so forth that goes on in this space is because not all blockchains are public permissionless blockchains, but ours are. And one of the things that enables is for anyone to investigate what's going on the chain. This is really important. It's so important, in fact, that we worked with a partner to create what we call the Aid Trust Portal.
Right.
So this is a technology platform that lets you investigate what's happening on the chain. So imagine you have humanitarian aid payment that's being dispersed to some, maybe 100,000 people. So it starts in one account and then it's dispersed to these 100,000 recipients. You want to know where it goes. And so using the public blockchain, you can use this technology tool to investigate the series of payments and see as the money moves around in the local economy, and hopefully it ends up in the accounts of merchants or other people and not all in the account of a warlord or something like this, right? And so the ability to use a public blockchain to trace those transactions is incredibly powerful. And this portal enables multiple layers, there's sort of what you can see publicly and it's all abstracted. And then if you want to go deeper into the KYC data, right, actual personally identifiable information, a regulator or a government agency could go a level deeper and perform an investigation in the either for a regular audit or if something happened and they need to investigate a specific situation. So, the technology tools at the base layer enable all of these outcomes around risk management, around fraud prevention, and so forth, when you combine them with the layer on top, which is businesses that are doing KYC and user onboarding and solving those last mile challenges.
Thank you. All right, we're going to keep going on the question of scaling. So you guys have all sort of intimated that one of the challenges is every country's different, or big upfront costs. So to really scale, you're going to need an ecosystem where you got a lot of different parties working together, all rowing in the same direction. And I'm curious to know, do you all think that's going to happen? Well, starting with you, is that going to just happen eventually? And are the right incentives in place? Because what strikes me now is we're in this funny world of intense concentration of stablecoins, but there's going to be a lot more. So will that concentration, really become much more diffuse and maybe come back at the end of the day? Will things be more concentrated again to allow for interoperability? So I'm just curious to get a sense of how you think it might all play out.
It's a great question. There's not a day that goes by where there isn't some sort of big announcement from a financial institution that is looking at stablecoins and other tokenized assets. So it is here. Karen, I love the last quote that you had from the IMF, which is, it's going to disrupt the existing financial system. How many people here think the existing financial system works?
Yeah.
For the record, no hands were raised.
No hands are raised, right? So disruption is actually not bad. So I think the incentives are there to actually move to this brand new state. That brand new state is to have more players in the financial ecosystem. Something that Brian noted is, the beauty of public blockchains is about accessibility, right? Anyone can access it, anyone can build on it. And that's kind of what we're seeing in the ecosystem. I'm working with some institutions in the South Pacific Islands, right? And what they are saying is, hey, we actually don't have any correspondent banks that we can go to or respondent banks that we can use, right? And it's fascinating because, yes, today the global financial system is not serving all financial institutions. It's not serving all people. And that is the incentive behind why I think stablecoins and other digital assets are being adopted at the rate that they are. Do small Pacific Island banks need a US or global bank if they're able to use something like Circle's USDC? The answer is no, because it provides an equivalent use case. When I look at individuals themselves, I did a study a few years ago to look at, who's actually holding crypto? And the people holding crypto, at least a few years ago, was the same demographic group as the unbanked and underbanked in the US. So it would be men of color, young men of color, and those are the same group that is unbanked and underbanked in the US. So the incentives are there to basically change how we think about the global financial system, both here in the US, and we have a pretty advanced system, and also abroad where, a vast majority of people do not have access to high yield US dollar accounts. People do not have access to investment products. Credit is extremely hard to get in many places. And these are the problems I think blockchain and our foundations are trying to solve, which is how can we make the financial system more accessible to both individuals and also institutions.
So Mary, any comment you have on that would be great, but also maybe just, I'd love to hear your thoughts, but you were talking about the G20 and maybe this would be an issue for the G20. And right now, there are countries in the G20 with very, very different views on stablecoins. China, extremely hostile, and the US, really bullish. So maybe you could talk a little bit about how that could play out, and if they were, in an ideal world, to come to some sort of resolution in the G20, what would you like that to be?
Yeah, happy to. I think first, just on Paul's comment, and this is maybe more of a follow-up question for you all, if I'm allowed to do that, is how I see it is I think that I agree that the concept of a global blockchain and the underpinning technology is going to be ubiquitous. But I wonder if this like the stable coin, I think that there are specific use cases that you mentioned where stable coins are going to be the denomination of the transaction. But I think that there are probably other cases where the user is more agnostic between stable coins and other digital, whether it's digital money, whether it's CBDC. And I think to me that's going to depend on the supply and where governments are moving forward in some of their different payment projects they have. So for me, it's not an absolute that stablecoins are going to dominate this space. I think that they are probably going to be huge, but I think it's more of the underlying technology that's going to be really important, not just in the payment space, but more broadly on digital assets and tokenization across the financial sector, where that's going to be the innovation. And then on Brian's point, just to add on, I think it's really interesting, and we were talking about this in the back as well, that there are all of these risks that are well known in this space. And I think it's an interesting case because you actually have a lot of companies and a lot of players in this space who are committed to public blockchains, who are committed to backing their stable coins with transparent liquid assets, who are actually calling for regulation to be stronger because they see the risks in having a destabilizing event across these many different areas I mentioned. And just for like sheer competition and some of the private sector entities, they know that like they can compete in that front. So hopefully they'll push the regulation up, and it's not a race to the bottom on the regulatory front. Now on the G20, Karen, you rightly mentioned there are a lot of different voices in the G20. I'm not exactly sure what Treasury and the Fed are planning in this space quite yet. If I were planning it, I would have kind of a dual track. I would have maybe a behind the scenes without a specific deliverable, like frank conversation between the players there. I think that would be incredibly helpful to get the key players in a room and just talk about what they're doing. You'd have India, you'd have China, you'd have the EU, the United States. You'd have a country like Argentina who's kind of facing it on the other side of it, and just have a conversation about where their regulatory frameworks are going and what the gaps are. Not sure if they'll do that. On the actual output side, where I could see them, finding more common ground is on what the approach should be with some of the developing countries that are going to be, facing the spillovers of their own policy choices and developments in their countries, but also the spillovers from the advanced economies. And that could involve, recognizing the risk to them. It could involve, telling the IMF and the World Bank to up their game and providing assistance to these countries and engaging. And this is not a new topic in the G20. There have been several milestones over the last 5 or 6 years. I think there was a roadmap that came out in 2022 or 2023 that has some recommendations. So they'll probably at least do some follow-up work to see where those recommendations have progressed.
All right, thank you, Mary. We're going to just do one more sort of lightning round, and I want to make sure we have time for questions. So would just love to hear from each of you what you think the most important policy or regulatory gap is that needs to be filled, either by the US or an international standards setting body or both. Like what would most help this agenda in your view?
So yesterday and today, I've been at the Blockchain Policy Summit across town, and there's been a lot of discussion about the market structure bill that's being discussed in Congress right now, in the Senate, and the Genius Act that was already passed and how they intersect. And I think it would be fair to say that these novel digital assets sometimes exist in a space that just doesn't fit nicely into laws that were passed many decades ago. We try, but it doesn't really work. And so I think it would be fair to summarize the industry's view that we want reasonable and clear legislation so that it is stable, not easily or quickly undone by a new administration in a few years, and the industry can then go into a phase of innovation, and we can let people and let the markets decide what disruptive financial innovations they actually want and that solve problems for them here and of course abroad as well. So the devil's in the details with these things, and there's debates about stablecoin yield, there's debates about developer protections and so on, and you can really go down the rabbit hole very quickly on the details. But having a reasonable framework so that small businesses can start, large businesses can confidently participate is really, really important for economic activity to sort of naturally proliferate. And at the moment, everyone's sort of paralyzed, not knowing how to operate in this space.
Yeah.
So a lot of people have been on the sidelines.
What do you think?
I agree with everything that Brian said. As a former regulator and standard setter, I'm going to take two controversial positions.
Oh, goody.
One is the focus needs to be on access to central bank services, right? So today we limit access to central bank services to basically banks. We need to kind of expand that if we actually care about the risk management of stable coins, which means access to payment services. Circle today, for example, relies on banks.
Yeah.
Banks do not operate 24/7. They do and they don't, right? They cannot liquidate assets fast enough if there was a run on USDC. And it goes back to part of it, from my perspective, is they don't have access to basically central bank services. The second is that it's still early days. We talk about systemic importance. It is not there yet when we think about the complete scale. So yes, these numbers are impressive, but do they rise to the level of systemically important systems? The answer is not today. And there's a lot more innovation that needs to happen. Mary talked about are stablecoins the future? I would argue, from my perspective, they are not. What I want to transact in are tokenized money market funds. I should be earning interest every minute, every second of the day on my money. Today, we can do that. Franklin Templeton, for example, has a tokenized money market fund where it allows for peer-to-peer transactions. If we all had Benji accounts, we can actually transact with each other using tokenized money market funds. Why should Circle and Tether earn interest on my funds? They should not, right? So I think the future are really assets that pay yield. Today, PayPal, which is also on Stellar, offers yield. Do they call it yield? No. It's a reward. Is there a difference between interest yield and reward? I leave it up to the regulators, but for me, it's kind of like the same thing. We just call it by different names because it's subject to different regulations.
Well, since you've gone down that road, maybe you could just explain the controversy around the question of interest and the stable coins, which I gather is still going to be worked out potentially in the next round of legislation.
It's a great question. It's not something that I'm not a lawyer, so let me qualify my statements by saying that. The Genius Act basically prevents paying yield. So in many cases, some issuers get out of that by calling a reward. The reason why people don't call it a interest is because it might be subject to banking or securities law. So is a reward the same thing as interest? I think so, but I'm not a lawyer. I'll let the lawyers debate on semantics.
Yeah.
I think in the Genius Act, it was a negotiation with the banks to differentiate them from deposits, so it didn't seem as a direct competitor to deposits.
Yeah, the banks aren't happy about this. But anyway, all right, so your thoughts on?
So I agree with Brian and Paul's points. I think for me, the two biggest risks are, you have large holders of U.S. Treasuries, making sure that the regulations are in place to ensure that they underpin their peg, so we don't put, there's not a potential for a run on U.S. Treasuries. And then the second piece, more of a day-to-day. I'd say the first one is more of the catastrophic scenario. The second piece is more of a day-to-day, and that's on the illicit finance compliance, making sure that when Treasury is writing the regs, that there is adequate responsibility for all of the key actors in the system to comply with Treasury sanctions rules, and also that Treasury has the authority and also the capacity to monitor and enforce their rules throughout the system.
Yes, please, go ahead.
I'm interested in sort of the Treasury part and the run on Treasuries, because oftentimes I ask this question to people: do you trust the central bank, which is fiat currency? Do you trust bank deposits, which is basically trust in our insurance deposit agency? Or do you trust U.S. government securities, right? And I think the logical response is, I trust that the U.S. government will save the Treasury securities more than I trust the FDIC coming to the rescue of a bank. And on paper, tokenized deposits technically are subject to a limit, right? Like if you have $500,000 in a bank account, not all of it is federally insured on paper. What we do in reality might be completely different, but I trust, for better for worse, that the US government will come and save the Treasury market, which is why when people talk about, hey, we might have a run on Treasuries, it's like, sure. Is the US government going to step in? I think so. And as a former Treasury person.
I mean, I guess we like to set up regulation to prevent the need to have to come in and use our resources to bail out different markets.
Experience shows
yes,
that the US government will step up and save the Treasury market.
I mean, with the money markets as well, right?
And that's why I'm thinking, the future really is in tokenized money market funds versus tokenized bank deposits or even stable coins issued by non-banks or bank subsidiaries.
Okay. All right, we've covered a lot of ground. So I wanted to make sure there's time for questions. Nico, do you have questions from online? You want to hand those? Okay. Oh, and then here, yes, let's have, please go ahead. Oh, there's a, yeah.
Hi, thank you so much for the panel. My name is Karen Vega. I work on tech adoption. So I know sometimes how it's difficult that people or companies would adopt something. So I wanted to touch upon the question on interoperability. You mentioned that it's a challenge. How is your company, how is the state or regulators dealing with that? Thank you.
Ooh, that's an interesting question. I think there's maybe two ways to answer that question. One is, when we saw the graph earlier for the stablecoin volume, you could pretty much only see Tether and Circle's USDC. And then there was, in a footnote, a list of like another 10 or 12 stablecoins that have been created. And there's a bit of a Cambrian explosion happening right now in stablecoins. And this is going to create some interoperability problems, because if I want to pay you in stablecoin A and you would prefer stablecoin B, now we have an interoperability problem. And we're going to have to innovate around that. And people will solve this problem. I think that's an easy one to solve. The other interoperability problem, which I don't think there's any regulatory attention on, is between blockchains, right? If I want to send you a stablecoin on Algorand, but you would prefer to receive it on Stellar, our blockchains have to talk to one another. And there are bridges and other technical protocols that can connect blockchains together so that you can move an asset from one chain to another. But we're just getting people's heads around stablecoins, let alone bridging protocols and things like this. So there's a lot more work and education to be done to get to the point where I think regulation can address interoperability. At the moment, we're just focusing on sort of defining the things in the first place and slotting them into existing regulations and writing new ones. But you ask a very important question, because if we end up with a graph where there's a dozen different stablecoins, now you've eroded the fungibility of currency in a way, and the economy is going to have more friction rather than less. So I don't want to see us there. Being on the technology side, I think there's a lot that we can do to sand off the rough edges there and abstract it away from the end users.
Do you think?
The problems that blockchain and crypto faces are not new. Once upon a time, we wrote checks in this country, and maybe some of us still do, right? We wrote checks, and if a bank was failing on the weekend, the other bank does not need to cash your check, right? So in many ways, there was that interoperability problem in the past because I don't need to cash your check, or I can refuse cashing your check at the other bank if I see that you're banking at a bank that is going under or failing or whatever. In many cases, we're operating in the same environment. We just don't have that level of maturity yet where we can say the PayPal dollar is the equivalent of USDC, even though they technically are. I think we will move to a world where technology will take care of these issues. So if I, for example, had a PayPal dollar and I sent it to your Circle account, I'm pretty sure at some future state it will be fungible and one for one. We're just not at that point yet. The technology part between blockchains, I think, is an issue. I think there will be services, well, there are services that are in development that will kind of do the conversion for you. So in many ways, it's still early days. Have we faced these problems before? Absolutely. Is there anything new here? I don't think so. The newness is really about the technology, and I think we're going to solve these problems with technology.
Very optimistic. All right, I'm going to share a question from a virtual audience, which relates to the off-ramping. So just in case folks don't know, off-ramping is, you're converting your stable coin into a regular fiat currency. And so somebody is asking, do they really solve the problem of sending money quickly if you still have to on and off ramp? And you kind of got to that a little bit, but maybe if you could expand on that. And particularly the question of, is that where the fees might hit you? Because, one of the stablecoin advantages is it's very, very low cost to send and receive them. But if you have to then convert them, is that going to take away from that particular advantage? And then if you could speak to the challenges of off-ramping, especially in fragile and conflict states.
Yeah, so maybe taking that backwards, the fees definitely kick in when you are off-ramping, because the work that kicks in is identifying to whom you are off-ramping.
I see.
Right? And the more fragile the economy that you're operating in, the harder that can be to do. People may not have government-issued IDs and things like this. There are efforts underway to issue digital IDs to folks to bring them into the financial system. But the off-ramping is still high touch, right? And as a result has costs, and that's where you'll run into the largest fees. Actually, sending a stablecoin payment from one country to another on-chain costs a tiny amount that rounds down to zero, virtually free. And I guess the extent to which off-ramping friction and costs interfere with economic activity depends on what you're trying to do. So in the Afghanistan example, we've learned that people are readily excited about paying their electric bill and their phone bill and doing things online with these funds that are digitally represented, but then in a store they still prefer to do things in cash, and you have friction there because they've got to go through the off-ramping process. But with time, more and more of our economic activity is digital, and so you don't necessarily have to off-ramp.
Yeah.
You can do a lot inside the digital economy, and only when you reach the edges and you've got to go outside of that, you need to incur the off-ramping friction and cost. So, in many cases, though, the hard part today without blockchain is the cross-border payment. That can take days, weeks, months. The fees can be astronomical. I heard a story the other day about a large lump sum payment across borders in the Middle East, and by the time it reached the final destination, 50% of it had been eaten up by fees. Wow. Yeah, so it's absolutely staggering what it costs to move money across nation states and especially into fragile states. And there's a lot of people involved, and it costs a fortune. So if you want to send a remittance, you can sidestep all of that from here to Nigeria or here to the Middle East using digital technology. And then the recipient has the option to off-ramp or not. They may not need to.
Yeah.
I just want to ask a question here, and I can't see the folks virtually, but how many folks here actually own USDC, PayPal, dollar, or other digital currency? So it's a very small minority, but if you use it, you will understand the power that it has, which is you can move money anywhere around the world for nothing.
Yeah.
The challenge, I think, as we've talked about, is really off-ramping, and that's where all the expenses come back in.
Yeah.
But one of the things that we're trying to do within the blockchain community is offer additional products. So like investments, one of the things that we've noticed is that, this might be also true in Afghanistan, is that when people originally first received money, they weren't sure what this was about, and they would automatically cash out all of it. What we see today is people are now used to the technology, and they will keep the money in the digital wallet, and they will use it to do things like invest in a high-yield US dollar savings account, a high-yield Mexican securities product. So once people gain comfort, they will keep the money in the ecosystem. It's just that initial payment where they're like, is this going to disappear tomorrow?
Right.
Because they're just not. They don't have that financial literacy yet, right? But once they understand the power, they stay in the system, and then they start using it for merchant payments and online payments and whatever else. The ecosystem.
How ubiquitous are the merchant payments at this point? Like how easy is it to use stablecoins to buy?
It depends where you are.
Yeah.
I think it's fair to say at this point that in many cases, the merchant payment is abstracted, and they don't necessarily know that they're receiving a stablecoin. We haven't yet reached critical mass where everyone is ready to receive stablecoins directly and wants to receive stablecoins directly. So there's a lot of business solutions through cards and apps that are moving money in the background, hidden from the user or the merchant, right, the buyer or the merchant, using a stablecoin or other tokens on blockchain. But the sort of the interpersonal conversation that you have, stablecoins are not mentioned, right? But we may be reaching an inflection point where there's enough money in that system that you get the network effects, and people are like, oh, I would love to receive USDC on Stellar, for example, because then it goes right into my investment account, and I start earning yield immediately.
Like that. Oh, interesting. All right. Are there any more questions in the, yes, please, and we're going to get you a mic real quick.
So I can see the case for the efficiency of the payment system, right? But we also know that for development, financial deepening is critical. And stablecoins can be associated with financial disintermediation. So how do we prevent that we end up in developing economies with no national financial system and the monetary policy dependent on the US?
Yeah, actually, that's, I'm just going to say that one of the questions from the virtual audience is on the risks of dollarization. So, and yeah, potential political consequences.
I mean, I think it's a huge risk, and it's, the other side of the, the off-ramp, and the idea of, we've seen already in some economies where there's, inflation or exchange rate instability, people demanding dollars or dollar stable coins. Argentina, Venezuela, I think you mentioned Nigeria. And I think that there's not actually a really good solution. You've seen countries banning it. You see the IMF in their recent report saying, this is why countries need to have sound monetary policy frameworks, which the countries should have, that's existing advice. So I don't have a good answer. I think it's one of the really big open questions. And I think that that's where some of the advice comes in, is that countries really need to weigh this huge risk. I think there's also the capital flight issue in times of stress with the potential benefits and, whether that's worth it to them.
You're raising really important questions, and I think competition is good, whether that competition is local or global. Folks often ask this question about dollarization, and my response is, if you cared about dollarization, you would focus on the top 5% of the richest folks in that population, right? They're the ones with dollar accounts. They're the ones who have access to investment products. Why is everyone preventing the bottom 95% access to the same financial instruments that the top 5% have? So when people talk about, when the IMF is like dollarization, like we don't want it, focus on the top 5% because they're the ones who are owning like 90% of US dollar holdings or dollar assets. Allow the other 95% of the population to protect their wealth, to gain wealth, versus saying, oh, it's, US dollar products are only available to a very limited subset
Elite.
of the elite population.
Yeah.
Right? And it's very hard to, for me, the international financial organizations can't really respond to that because it's like, yes, everyone should have access to the same products regardless of where you are on the economic spectrum. So again, if you care about dollarization, focus on the top 5%. Just allow everyone else to have the same access to the investment assets.
I would just add briefly, I'm not a policymaker, but taking a pragmatic view, dollarization or the avoidance of dollarization is not an outcome for people, right? If you can bring people into the economy and improve their lives because they can get a loan to help their small business, or they can get medical treatment, or even just buy food because they've been able to receive an aid payment that's denominated in a currency different from their local one, that makes a difference in people's lives. So if there's a trade-off between dollarization and just stimulating the local economy, like we have to think about what are the actual outcomes that we care about. So,
Other questions from the audience? Please, Samuel, and then over to you.
Hi, Rachel from Stripe. I'm curious to better understand if there are any examples of stablecoin adoption leading to more fraud risk in these developing countries or in areas where there's unstable economies.
Great, because before you answer, we have another question that says, similarly, what should stakeholders, including stablecoin issuers, do to ensure transparency and accountability? So same kind of question.
yeah, I don't have great data on the fraud rates, but I understand that in like traditional humanitarian aid payments, something like 10% goes missing, and so the premise of the question needs to be examined, right? If the cash-based economy has a fraud rate of 10%,
Right.
what's the fraud rate in a stablecoin, blockchain-based, payment economy? It might be lower because people know it can be traced, which cash cannot. And Paul was talking about ways that payments have been made. In some cases, like in Afghanistan, the payments were pallets of cash dropped out of the back of an airplane. And then men with guns stand around and guard the line as people line up to receive their payment. So that's the alternative. So yeah, I would sort of argue with the premise of the question, no offense, that there's necessarily more fraud, because it may actually be less. And tools like the Aid Trust Portal that we've developed with a partner allow anyone with access to investigate where these payments are going and take action much more quickly than if there were fraud in a cash-based economy.
I mean, I just add, I'm clearly focused on the illicit finance risk of this, but I completely agree on the, point-to-point, aid payments, that especially if you're dealing with an organization, which you all clearly are, where you're committed to having public blockchain, there's transparency. I think one of you made the point that these payments, unlike cash where you give it and it's gone, can be monitored and traced and even potentially stopped if needed. I think that's a real plus to this. Maybe there is still some fraud, but it would need to be something to be measured and looked at closely.
I think there are data analytics firms that have concluded that there's not as much illicit activity on blockchains as people fear, and those are coming from the data analytics firm. I think when we're talking about real-world assets like stablecoins, issued by reputable firms, the fraud rates are actually lower than I think maybe even traditional banking, right? There's not a year that goes by without some billion-dollar fine to a globally systemically important bank for not meeting their AML KYC requirements. So again, I think we need to kind of do an apples to apples comparison and see what those numbers look like. But my suspicion is it's probably around the same. It's probably around the same.
I just wanted to add to that. When I was at Treasury, there was an effort supported by Treasury and the Fed to introduce new currencies to Afghanistan and Iraq in a technically post-conflict, but not really post-conflict. And the logistics around bringing in that money and getting it around the country. I mean, it took the entire U.S. Army in both countries to do that because it was so complex and the risks were high. And then it was also, it really affected productivity in these countries because of how far people would have to travel when they were getting paid. You know, a civil servant working outside the Capitol would have to come home once a month. It could take a couple of days just to pick up a salary. So it does speak to, and there was, you know, lots of risks. It was basically, in order to really manage the risk in a cash situation, you need, it takes a lot of effort, which itself shows it's just not terribly efficient. All right, we had a question. Nancy.
Hi, thanks. Nancy Lee here at CGD. You haven't talked that much about use of stablecoins in credit transactions, either holders lending their balances or borrowing against their assets, which would seem to require a whole lot of regulation if you move in that direction. And that seems key if you want stablecoins to reach critical mass as an instrument in a financial system. You know, just payments and even a store of value is going to limit the demand for the asset. So what's your thinking about you know, moving into credit transactions using stablecoins?
You want to take that? Sure. So, you know, it's a pretty vibrant ecosystem that we have, which is the DeFi stuff. I will be honest, I don't focus on the DeFi stuff because for me,
Decentralized finance.
Sorry. For me, it's really about real world use cases. The challenge with credit products in sort of like the real world regulated space is we don't have scale yet. So like to issue $100 in terms of a loan product in Afghanistan or $50, it's like a lot of work for very little return. So, you know, my lesson learned in the credit space is we need to go big. So can we do things like securitize a bunch of loans and then sell it off to a bank or to somebody else? The answer is that is more profitable than having a microfinance institution issue 100,000 loans at like $10 each on the blockchain. Can we do it? Yes. Is it low cost to the blockchain? Yes. Are we working on it? Yes. Do I think there's scale? Not yet.
I would add that lending is a trust and risk management business, and for the most part, you know, stablecoins enable cash basis transactions and the ability to borrow in a fully collateralized way against your own holdings, but borrowing more than your own holdings is going to involve talking to an intermediary that extends some credit to you. One interesting benefit of using blockchain for payments is the history of payments that you make, even if you're not borrowing, even if you're just paying your phone bill every month, paying your rent every month, can establish a credit history. And we've worked with a partner in Nigeria who enables people that receive remittances from the US and then pay on time for things on a regular basis to develop a credit history where they would not otherwise have one from one of the major rating agencies. So there's some technology solutions that are possible if you're transacting on chain and you can see that someone is meeting their obligations on a regular basis, then they can become a better candidate for a lending transaction from an intermediary. So there's possibilities there as well.
And just to add, I mean, I agree with the premise of Nancy's question completely, that this is a huge area of risk. And, I think that regulation, in the US, whether it's in the market infrastructure bill or in, countries where this is other countries where this is happening, you just needs to make sure you're not creating a gap between, other non-bank financial institutions and the regulation they have to have this like unregulated product that's a source of financial stability risk for consumers and also for the lending institutions.
Any other questions? I just have one, if that's okay. On the user case side, I was wondering if you could say something about insurance and how that would work with stablecoins.
Go ahead.
So a lot of the folks in development are looking at things like participatory finance, right? So it's basically providing insurance if there's a flood event or a drought event, using different things like AI tools, geotelematics, all this other stuff, right, to determine whether or not an insurance payout should be made or financing should be given to help people anticipate certain events.
Yeah, what I've seen in the Algorand ecosystem are some businesses that are tokenizing insurance, so that if you need an insurance policy against some kind of loss, let's assume it's your homeowner's insurance, I could actually like underwrite a fraction of that, and other people could collectively underwrite that insurance, because you can tokenize it and then slice it up into tiny fractions, and there can be some novel business models there. Another thing I will say about insurance is you can use stablecoins to accelerate the payments, right? If you have satellite imagery and you can tell that someone's crops were wiped out, you could expedite a payment to them right away. There's a project in the Algorand ecosystem that's doing something similar in the US. They're called Care Wallet. They've been doing pilots to send folks assistance after like hurricanes and things like this in the Southeast. And if you've had your house wiped away by a flood, you may not have the paper documents that you need to deal with traditional insurance, but if you've pre-registered and you have a digital wallet, you could get a payment right away. So there's some operational efficiencies that you can get by leveraging the technology in the insurance arena as well.
All right, thank you. Any other? Yes. Nico, any more online?
Hi, sorry not to derail the conversation, but it feels like we've talked a lot about the bank and the fund so far, and I feel like there's a third actor, especially given the need for central bank access in this space of the BIS. And I'd be really interested in some of your thoughts on the pilot programs that they've been attempting recently, especially with projects that have now reached viability, right? Like specifically Enbridge. Yeah, thanks.
Yeah, Paul, that one's got to go to you.
Yeah, exactly.
Thankfully, I don't work for these organizations anymore, so I can speak my mind. Enbridge is actually quite interesting. What it does is effectively replace existing systems. So we talk about, does the existing global financial system serve everyone? And the answer that you get from Enbridge is no, it does not. So what Enbridge does is basically expand who can participate in the foreign exchange market from my perspective, right? So today, if you do a foreign exchange transaction if you're at a major bank, you do it through this entity called CLS Bank, and it limits the currencies you're able to transact. And Enbridge is a desire to remove those limitations imposed remove those limitations that CLS has on who it's able to transact with and what currencies. Will it succeed? It's hard to succeed without the support of the US and other advanced economies, so we'll see. But this is an attempt, again, to reframe how we think about finance, and I think what we are really talking about in this space is really about access. And Enbridge is another question of access. Who has access to the current financial system? If you don't have access, these entities on the blockchain, entities participating in Enbridge are going to create their own access and create their own systems where they're able to transact in sort of a freer world.
Do we have any more? Okay, we'll take one more from virtual world and then wrap it up.
Sure, okay. This one's from the virtual audience, and someone asks, if the expectation is that the government will step in treasury markets, how should this contingent liability be reflected in public finances?
I think the expectation should, I mean,
That it would,
like with all nascent financial sectors, I mean, the regulation is supposed to prevent them from doing that. Yeah, I think there's absolutely no expectation that the government will step in.
Paul's point, I think, was, you know, that then stuff happens.
I don't think that anyone should be making regulation on that premise.
Yeah.
I mean, we have things that are on paper. What we say, what governments do is completely separate. And again, I use deposit insurance as a perfect example. On paper and in policy, deposit insurance is guaranteed up to a certain threshold or a certain amount. What we've seen over the last few years is, well, we're just going to guarantee everything for those particular situations, right? And I kind of see a similar thing.
I mean, I think that also if a stablecoin were to lose its peg and there was a run on treasuries, that would be a nail in the coffin for that company and potentially the industry more broadly, and undermine a lot of the innovation. I mean, I don't think that, again, the underlying blockchain technology is going anywhere, but the stablecoin as like the bipartisan consensus that I talked about would be gone in this sense. So I think that there's huge imperative, not just for financial stability of the United States, which is super important, but also to underpin some of these important innovations that Brian and Paul are working on.
Yeah. Okay. The only thing I would add is that if you look back at recent financial crises in the traditional finance world that cost the government and taxpayers in this country an enormous sum of money, blockchain is not necessarily riskier. Stablecoins are not necessarily riskier. We still have a fractional reserve banking system, and a number of legislative packages have constrained the banking and investment banking worlds over the past, call it 15 years since the financial crisis in 07, 08. And so, again, I would sort of reframe and say, do the stablecoin markets, backed by treasuries and other sort of cash equivalent instruments, really introduce a systemic risk of worse than what we already have in traditional financial markets? And I'm not sure that they do.
Yeah, that's a worryingly good question. I say worryingly because I'm just anxious about what's going to happen. And it feels like there are a lot of vulnerabilities in the financial system right now that have nothing to do with stablecoins, which I guess is, sort of the point. But all right, well, I want to wrap it up. I want to thank you guys so much. I feel like this was such a good panel. It was really fluid and it was dynamic and you were really interesting. So can please big round of applause for Mary and Brian and Paul. Thanks everybody for coming. And there will be more to come on stablecoins, I guarantee you.
Thank you, Karen. Thanks everyone for the great.